Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little bit of money here. My job is not just to entertain, but to explain. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. The consumer cavalry got here just in time to give us what looks to be the beginning of a Santa Claus rally. That's the only way to describe what worked today. Everything involving consumer spending couldn't come at a better time because tech's been faltering. We needed something big to replace it. Even as you couldn't tell from the averages, Dow advancing 66 points, S&P jumping 0.79%, but the tech-laden NASDAQ surging 1.38%. Let me set the scene. For most of the year, we've had woe is the narrative consumer, right? I mean, consumer doing so poorly. Higher unemployment, true. Inflation kept the consumer on the sidelines. We kept thinking that they were just decelerating. Retail was pretty awful, except for Walmart, which powered through everything as CEO Doug McMillon moved to keep prices low. His own one-man war against inflation. A war I think he may have won before he's retired. We didn't see the weakness in the averages, though, even though the consumer represents two-thirds of the economy, because it was masked by the incredible run in technology, led by NVIDIA, but followed by Apple, Microsoft, Meta, Tesla, and most importantly, Alphabet. Behind the scenes lurked OpenAI, the creator of ChatGPT, which, along with Oracle, have been huge drivers of the burgeoning tech spend. For most of 2025, those are the stocks that drove the market higher, and that was the narrative we loved. Lately, though, skeptics have begun to challenge the notion of unlimited data spending. Oracle raised a huge amount of money in the bond market, $18 billion, but there's now a belief in the market that Oracle may not somehow be money good for the financing of this massive data center build-out, something it's doing largely on behalf of OpenAI. That's the private company. You can tell because people have been buying credit default swaps on Oracle's debt like crazy. Now, I do find that somewhat worrisome, I admit it. I am glad to hear tonight, though, according to the Wall Street Journal, that OpenAI is trying to raise $100 billion at an $830 billion valuation. That's up from $750 billion yesterday. Not bad, huh? If it can raise $100 billion at that valuation, well, then the company can keep building out data centers aggressively, and stocks like NVIDIA and Broadcom should be bought tomorrow. I, for one, though, am delighted that the attention for the day was away from the data center valuations, because the artificial intelligence trade has become very hard to fathom, and Wall Street doesn't like hard-to-fathom valuations. So how did we start liking the rest of the market again? Was it just out of revulsion toward the AI trade? Well, somewhat, but it all starts with the consumer and what she has to pay. This morning, we saw a decline in the rate of inflation as measured by the Consumer Price Index. The core CPI, which excludes food and energy prices, fell to a 4-year low. Inflation had been eroding the consumer confidence and caused all sorts of consumer-related stocks to just get hammered. These numbers today show that inflation may have peaked, started to come down in a very positive way. So many different costs are indeed coming down. We can see that. We know gasoline's gone down sharply. Used car prices are down high single digits. All sorts of goods coming down to levels where they can move. And while it's not in the CPI, home prices, they are really coming down. We're going to have more on that when we talk about Lennar. But suffice it to say that the average selling price of some houses now below where they were in 2019. I thought that would never occur again. It's become a self-fulfilling world. If the Fed cuts rates, the consumer should spend even more. Hence why so many of these consumer stocks have been roaring since last week's Fed meeting. Of course, you got to ask yourself if the move is sustainable. I don't know, tonight Nike looks terrible, but that could be a lot of that is China. I think that the trend of lower prices, though, is just starting. Gasoline will struggle to rally given the glut in oil. That gives excess cash to the consumer who can spend it as she sees fit. Retail's such a huge portion of this economy, it can mask the questionable kinds of transactions we've been seeing at the highest level of tech. Consider the retail winners today. There's Darden. That's the owner of Olive Garden. It vaulted nearly 2%. Yes, the numbers from Olive Garden look great. Investment Club holding Texas Roadhouse gained 1.6%. Williams-Sonoma, we know how much we like those guys. Laura Albert, that's gained 2%. Target is up 0.46%. Kohl's finished up 1%. Look, you got to start somewhere. Let's not forget there's a lot of consumer in tech. Amazon, for example, is more than Amazon Web Services, even though Wall Street only seems to talk about that. Remember, they still have this e-commerce website that you're on every minute, and that's a huge, giant tailwind in this backdrop. So does YouTube and Waymo owner Alphabet. Apple might be hurt by higher memory prices from Micron, as we heard just last night. More on that later in the show. But a wealthier consumer may also buy more phones. Isn't it ironic that President Trump was railing last night about how Biden had left him with what was perhaps the worst inflation ever, when in reality it looks like the inflation story is coming down pretty quickly? The commodities themselves almost all have come down, except for cattle. If the president could give the cattlemen checks, we could take beef from Brazil and bring that price down, too. That's something that should be done. The Fed now seems justified in that last rate cut. The new Fed chief will have declining prices to allow even more room for easing rates. It's going the president's way. He seems to be so busy trashing his predecessor, he doesn't seem to realize when he's winning the war of inflation. Now, this whole market spent several years trying to get away from just owning tech. In the last few months, we've seen a tremendous broadening of this rally. The financials have been incredible of late. Citi's crushing is up 60% for the year. Goldman Sachs is up 53%. JP Morgan has rallied 31%. The autos have been getting stronger and stronger. Ford's up 35%. GM's gained 52%. Now it is retail turn, just in time for Santa Claus. The bottom line, the CPI number was terrific this morning. Consumer spending looks to be alive and well, and it's a huge win for the stock market. Best of all, it's a reminder that we can still rally big without tech, thank heavens. And when we get tech rallying and OpenAI gets its money, so that story's out of the way, it's going to be all the sweeter. Let's go to Dustin in Oklahoma. Dustin.
Booyah, Jimbo. Good to talk to you again, my friend.
Good to talk to you, Justin. Thank you for calling. How can I help?
Absolutely, absolutely. We had a great game against my Chargers 2 weeks ago. I'm sorry it didn't work out, but that was a great game.
That's just one of many. One of many to come. We got a couple of people in the do not playlist I don't like, but go ahead. Let's go on.
Hey, you're awesome. Let's get to work. Jim, my portfolio is pretty tech heavy, as I've talked to you before. So I've been trying to diversify some into a large, very cyclical U.S. industrial. I got back into it about 3 months ago, but I find myself watching the headlines a little bit more because the earnings are still negative and the business is so sensitive to policy. Yes. A big part of the international demand seems tied to tariff deals that are negotiated under Trump, and now the Supreme Court is reviewing the tariffs that could potentially impact those overseas fleet purchases. So given all that uncertainty, what's your long-term thoughts on Boeing still?
Okay, I'm glad you asked me about Boeing. It's a big position for my Chapel Trust. I will tell you unequivocally that I think Boeing is bottomed. I thought the last quarter was terrific. People sold the stock down huge off it. Now it's coming all the way back, and that makes a lot of sense. I think that Kelly Ortberg is the person who should be been running Boeing for years. He's doing that good a job. That's what I'm seeing. We've seen a tremendous broadening of this market over the last few months, and I think it's a reminder that we can still have a rally without tech, thank heavens. On Mad Money tonight, you called in and you stumped me on Enlight, so I hit the books on this company that specializes in laser technology, and I'm ready to give you my take on whether or not it's a buy at these levels. Then Lennar and KB Home both reported this week, and I'm homing in on the housing sector to see what's next for the cohort in 2026. And FedEx is on the move after the earnings crossed the tape, and I'm getting all the highlights from the company's CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.